Hi, yes, people, welcome back to another episode of the Navvai Shift. Today I got my co-host Darnell, and we got our guest based from overseas. His name is Matthew Komos. He is the founder and chief executive of Ogma Risk and Analytics. Matthew, how are you doing? You well?
Cheers, mates. I'm doing pretty great coming to you from across the pond and really excited to be on the podcast with you both and appreciate the invite.
Yeah, no, likewise, likewise. And could we have a brief introduction to yourself and what it is you do at Ogma?
Absolutely. So I've spent my nearly 25-year career in consumer credit, in risk management, analytics. I've worked in some small lenders, startups, big banks, and kind of everything in between. I've lived the entrepreneurial life for many years and in a few different organizations. And this latest iteration is really the culmination of all those decades of experience trying to bring sophisticated risk management and analytics to maybe organizations that, don't have the full capacity on staff or might look to just outsource some of their needs because they just don't know how to do it. And so we come across many different organizations, whether it's startups that we can lean on our own experience to help those folks, or even large institutions that really just need more hands. So that's what a lot of what we're focused on. And we do everything from custom score developments to risk strategies to creating reporting and visualization, a full-on risk assessment of the current environment, and really, try to bring our decades of experience to the table and really help out organizations in these gaps that they might have.
Nice, nice. Now I know you're bringing like a collaboration of years of experience from what you have done in the past, but what was it that prompted you to found Ogma?
Yeah, I was working at the time when kind of the idea came to mind, and this isn't my first iteration of doing kind of the consulting type of services in this space, but I was working at TransUnion, really great company, and I was leading our scores and attributes team. And there was a part of me that's, like I would say for the last 2 years, kind of that entrepreneurial bug kept smacking me upside the head and saying, you need to get back after it. And I think part of it was just understanding and seeing some of those needs that I described kind of consistently existing in the marketplace. And I felt that, having done it previously, and given my vast network in the financial services industry, I thought it would be a good time to kind of go off and do it again. And I'm actually bringing back a business model that I first did in 2006 with some other partners, which is to really create a blended onshore offshore model because we know that there can be economies, gained from utilizing maybe less expensive talent, but blending that with subject matter expertise. People that have done the things that the companies we're serving are looking to do, right? You want somebody that's actually implemented a risk strategy or has created an indirect auto lending program for a lender. And those are the folks I'm trying to bring together, to really create this sophisticated risk management enterprise with that knowledge and expertise, which, and we talked about this a bit, Josh, our motto is driven by data, guided by experience, right? And so for any of the organizations that we're working with, data is core to making good decisions, right? But most importantly, good data is core to making, good business decisions. And we want to couple that with our decades of experience. Analytic partner out of India, he's been doing this for decades as well. Worked at Citi, worked at TransUnion, led the analytics functions there, right? And so combined, we have, over 55, 60 years of experience in the lending industry. And so that coupled with some of the subject matter experts that we're bringing into projects and kind of lending people that expertise, we're really driving home that idea that you start with data, but you need the experience to really make that data powerful, meaningful, and to, be able to work for you.
So Matthew, just on the topic of data, I'm sure you're well aware that obviously some companies have great data and some companies have not so great data. So my question to you is, how do you actually deal with data that's just not structured in the best format?
Yeah, we do see this a lot. It's interesting because I've built a lender and I've actually helped a few startups like literally from scratch. So, At that point, you're starting with zero. And so there's actually some benefit to that because you can kind of structure things exactly how you know it should be. It's actually almost worse to come in and you see folks that they just didn't know, right? And so they've been gathering data and either it's sparse or maybe it's just not great sources. So we believe in kind of a foundational approach. You always start with what you have and you determine, can I extract any value from that? And then you build iteratively, right? So I like to think of it as concentric circles. Start with the most foundational kind of information I have, and then build out from there and get more sophisticated. And we'll touch on this shortly, but this is kind of where sometimes maybe fintechs or some folks in that startup phase kind of fall short. They might try to build the perfect data infrastructure from the get-go, and that can delay things, right? So even if, for example, we come across this situation where maybe the data isn't great, we still want to utilize what we can out of it and then start testing and learning, right? Start iterating. And so there's like a methodical approach to how you do it. The goal is always just to continually improve.
Sense. Also want to ask, so you said previously that you kind of blend the data with the appropriate risk strategy, but then how do you like firms know that their strategy isn't actually the best without having the like years of experience that you have?
Yeah, it's a tough, for many people, they only know what they know, right? So, and this is where things like reporting, early warning systems, indicators, KPIs, those things become really important because you might think you have the best, kind of available. If you're not measuring it, then you don't really know, right? That's where bringing someone like myself or our team in can be beneficial, especially if a company is trying, just kind of unsure of, do they have the best available risk strategy? A quick analysis can tell you, well, if I bring in maybe a new data source, or instead of just using a score, maybe I use a score and some rule sets. I can actually improve upon what I've already built. And there are ways analytically to be able to prove that, right? So I establish what's my baseline. If I'm lending, my first payment default rate or my 60-day delinquency rate in 6 months might be key measures. And then, I can say, well, if I add these new rules in, or if I change the data I'm bringing in, can I improve upon that delinquency? And in the past, this is where technology and things like AI really benefit people. In the past, you would often like implement a strategy, make an adjustment, then you'd have to wait. You just sit and wait for like, weeks and months for the data to bake. Now we can get more sophisticated about running simulations, doing what if scenarios, right? And I think that's where leveraging tools like AI and more advanced techniques really allow you to kind of stress test things immediately and then get that quick read. And that's why you see such great innovation happening and companies are able to make adjustments very quickly. I was recently working with a client. They were rebuilding their model literally every month, their main credit model, and it was because they created this automated process, and they could get reads very quickly. And as they were growing the business, they got sufficient number of records that they could just, instead of having to like back test and determine like, is this model working? They would literally just rebuild it again. It was amazing just to see like, and when I was growing up learning how to build credit scores, trying to do something in 1 month, you were lucky to finish the first project in a month, let alone, being able to actually rebuild scores once a month. So there's a lot of cool things that are kind of on the horizon and have been continually evolving as technology improves and as folks get into these more sophisticated techniques.
You did mention earlier that you advise for people to start foundational, but I wanted to ask, what early milestones told you that this model works? And is there any like early mistakes that occurred that helped you improve your approach?
Yeah, I think, one of the things that I learned early in my career was, ensuring that you really understand the data, ensuring that when you're creating a sample design for a project, that you get those components correct. The worst thing you can do is, get to the end of a model development, for example, or a risk strategy redevelopment, and something pops and you go, oh, shoot, that was because of this behavior that we didn't identify in stage one. And so this is something I always stress to clients, like, You really need to get those early pieces of the puzzle together correctly. We need to understand the data you're using. There has to be that understanding and fundamental agreement about, okay, what are the things we want to measure? What behavior are you trying to model? If you don't have that behavior identified in the data, there's not much I can do for you. Like we can't just model something that doesn't exist. And so it's those kind of components and again, learned that early in my career where, we got pretty far along on a project and realized we were missing some key data elements and had to start all over. So good, that's where experience comes in, right? Having done many such projects, in-depth, complex research projects. These are things that kind of have shaped the way I try to approach engagements and, the folks that I work with, that's the approach we take.
So would you say, sorry,
But go ahead, Josh, go ahead.
I was going to say, have you found that better reporting alone can change behavior and outcomes?
Could you repeat that?
No, I was saying that, have you found that better reporting alone can change better behavior outcomes?
Yeah, I think so. When you talk about reporting, do you mean internal reporting and visualizations of what's happening versus something like credit bureau reporting or
Internal.
Yeah. Okay. Yeah. I mean, to be frank, if you don't have kind of the right visualization tools and the measurement tools in place, oftentimes, you might not actually know what the outcomes you're seeing, what they mean, right? So prime example, I was recently working with a client and they were seeing their conversion rates falling. And what they weren't looking at, which I brought to them was, well, you're getting a higher proportion of people that aren't answering your phone call in the data, right? And they didn't have this measured in their data set. So we started looking at, okay, I see a consumer that comes through, they look interested in a loan. All of a sudden, they just stop communicating. And so that was driving down their conversion rate, but they didn't look at it. They didn't have that in their metrics, right? So now we can say, okay, instead of just identifying these people that are not likely to respond, let's try to identify that higher in the process and just not let them in the process at all. So now you change the way you think about that strategy and the behavior of the company to say, I don't want to bring in a bunch of leads that I can't chase because they're not answering my phone call or my emails or my text. That now is driving my conversion rate down. My cost to acquire goes up, right? So let's get them out of the process altogether as best as we can. And actually what we're doing is we're bringing in new data sources that are cheaper to kind of pull them in higher up in the process and get those non-responders out, right? So there's a good example of wasn't being identified in the existing reporting through our investigation. And we were kind of asking about, have you looked at this? What are you seeing in terms of these behaviors? We don't know. So we started creating that reporting and now we're changing the whole process, right? So that's often how it works in terms of just, again, because I've been there and done that and my partners that are the same, like we know these are the types of things to look for. And that's where we see opportunity to really help companies bridge those gaps. And again, it's not necessarily like they're intentionally doing something wrong or they don't have smart people on board, because all of them do. It's sometimes just they haven't had that experience. They don't know like, oh yeah, these are the things I should be looking at and start reporting on it. And so then I can take it back and change my process.
So you're business to business then?
Yes, we're focused solely on business to business, although we will help businesses with their consumer direct kind of engagement, right? So many consumers are wanting to understand how their credit's changing, what are improvements they can make to their credit so that they can get that mortgage or they can get a new credit card. So we've actually had some engagements where we help, the company itself is a business, maybe they're offering loan products or they're a bank, but they have this engagement side with the consumer to try to help with their financial health, their financial literacy. And so, we've done some work in that area on how to position those types of tools to the consumer. Because at the end of the day, we're all consumers ourselves, right? So I just think about, okay, if I have these types of questions, how would I want them framed back to me from this financial institution, right? And so we can bring not only, that kind of perspective, but then decades of experience working at credit bureaus and understanding when you change a behavior as a consumer, what does that do to my credit score? And how does that affect my ability to get credit? So it's combining kind of those different perspectives to provide those types of solutions.
Makes sense. So Matthew, I did want to ask, so obviously you've had multiple engagements. In terms of like the KPIs that they don't measure, are there like any commonalities or are the KPIs just very unique to the actual business?
It really depends on the type of business as well as, are we, a bank versus a credit union versus maybe a fintech? They have different deficiencies and for very different reasons, right? So in a lot of banking institutions, they have long used legacy systems. A lot of things are maybe siloed. And so the KPIs might be in very different places. Like there's not a single view of the health of the business. And frankly, like in a banking institution, you might be dealing with tens of thousands of employees, right? And each function, they divide a lot of the functional processes into these different groups. So within a credit card portfolio, you have folks focused on originations, then you have folks that are focused on account management and then collections, and they're all focusing on their specific functional roles and not tying it all together into like a single dashboard. So that oftentimes is, you get into some challenges in those larger institutions just because of how they're kind of segmented and the way they approach risk management. In a credit union, they just don't have enough people to actually do all the analytics and maybe to run all the dashboards and create the reporting. So that's like a different issue, that creates, and some of it's also just they don't have the knowledge to say, okay, these are the KPIs that should be of interest. So maybe they've been using the same KPIs for the last 30 years and it works for them because they know how to make decisions off of that information. But that could mean they're leaving money on the table, or maybe they're making suboptimal risk decisions. And then you have a fintech, right, where you might get, they might build out this great tech stack and they have the ability to bring in all kinds of data and data pipelines. And there just might not be as much experience there in terms of, okay, what are the important KPIs? Now, realistically, I would say that'd be maybe more earlier stage or a couple years ago fintechs. If you look at the industry, what's been happening is many fintechs are pulling from these institutions, banks, credit unions. They're pulling those folks into their, they're putting them into management positions. And so that level of experience, I think, has started to shift within fintechs now. And you start seeing a lot more what I would expect as traditional KPIs, early warning systems, things that, need to be watched, right? So again, it's really dependent on the institution and kind of the nature of the business.
So, I can tell you're just so knowledgeable, Matthew, honestly. I do want to ask, so how do you reckon the AI kind of ties into the KPI? Because obviously now with AI, you can get so many different data points, which can be a good thing and a bad thing in two senses, because obviously now you have so much data, but now it's hard to identify what you actually need versus what you don't.
Yeah, no, absolutely. And I think that can be sometimes where firms fall short of. I would consider there's like here, there's a set of standard KPIs that really give you a sense of the health of your lending portfolio. Vintage curves, roll rates, early delinquency indicators, right? Origination rates, approval. There's just sets of KPIs that make sense. And I'm sure if you asked AI, it would provide, some perspective on that and give you a great set of standards. There's also a piece that I think this is again where I think some firms fall short. It's understanding, okay, what is the data telling me, right? So it's one thing to say, well, this KPI doesn't hit what I would expect. Okay, well, now the question is, what do I do about it? So it's like forcing action. It's one thing to report on things and to identify these trends, but it has to translate to actionable, insights. And so that's where I think, again, I go back to my motto, which is driven by experience, right? Because the experience part tells me, okay, if I see that my first payment default rate is hitting X%, that means my charge off is likely going to be Y%, which is way different than what I've projected. And so now I have to go back and say, okay, what do I do about that? Something is going on in my originations, or what I forecasted isn't coming to fruition, or my collection rates aren't coming in correctly, right? So it's that piece, which is, okay, once I identify there's a potential issue, what do I do about it? Then secondarily is understanding the dynamics of, when I see a specific delinquency rate, how does that translate or correlate to charge off, right? So, and if it, if I see, for example, a bunch of my early stage delinquency is going to charge off, that means my collections aren't very effective, right? But I have to understand, my roll rate analysis tells me that I'm seeing accelerating roll rates, meaning, payments are not coming in as the consumers get more and more delinquent. Something is not working in my collections, right? At that point, my origination piece is kind of, I don't worry about it as much because I have to focus on collections. Now, here's a great example. If I see that my first delinquency or early delinquency is coming in higher than expected, and I'm not getting kind of good collection results, now I have two problems, right? So I have to address something's going wrong in originations and then subsequently in collections, right? So it's really being able to isolate and understand these causes and effects that are happening in a lending portfolio. And again, that's where I say, I think that's where, a firm like ours helps bring that insight and can help guide the company on, where to go next.
I can definitely tell that there's a lot of moving parts, and I can imagine you must be stressed out sometimes, Matthew.
Well, the good news is, as you can probably tell, I'm very passionate about it, right?
I can see that. It's very
And
clear.
yeah, I mean, and my background is in economics, mathematics, and statistics, right? So, and all of that made sense to me. Like, you push a button here and you see a result here, and I can measure it, right? So, one of my favorite courses in undergrad was econometrics, and because it
I
like,
hate econometrics.
and it was one of my favorites because it kind of brought it all together, right? It's like, I can look at things from a macroeconomic perspective and understand when there's a push here or a pull there, what's the trickle down effect, right? And again, going back to lending, understanding the backdrop under which consumers are making decisions is really important. And that backdrop is the macroeconomy. So if you see things like interest rates going up, that changes how a consumer views a loan product or affects their ability to pay, right? And so it's all connected. And so having that understanding kind of filters into the way you think about your strategy. How do you build your credit risk environment and framework and make it flexible so that as the macroeconomy shifts, you can now be nimble, right? And change. And that's where, over time, we've seen a lot of companies that aren't able to kind of shift quickly, they often fall behind, and other firms are going to identify those consumers that need a loan or are struggling and step in and gain that market share.
Understood. I did just touching on that because obviously I feel like risk. Some people can interpret in their own ways. It's up to how you want to interpret that. So I'm guessing you've had a couple of conflicts with clients. So how do you actually deal with that? Even though you are the professional and you can see that this is the optimal decision, but when you have when you have someone that's, I don't know, they're just, their viewpoint is a bit different. How do you actually deal with situations like that, even though it's better for the client?
Yeah, it's very common. I mean, it's a fair
I can
question
imagine.
because it happens quite a bit, because many customers of ours or clients, they've been doing things in a certain way, and so that's their perspective, right? And reality is, the way all of us approach a problem is directly influenced by our own experiences, our perspectives, right? And so we try to be as collaborative as possible with that client and kind of lead them by the hand through the process, right? It's hard to refute when I can show direct empirical evidence, or, if I say, look, this risk strategy is better than this one, and this is why, and I can show you a difference in profitability by consumer, or, the risk shift is significant. I mean, I'm going to make my case, right? And then that's my job as the consultant to say, based on my experience and what I know, these are the things you should be doing differently. If a client does not necessarily want to follow that, at the end of the day, there's nothing I can do about that, but provide that recommendation, and I'll say, you know, I think this is the better way to go. Why don't we test it? Right. So
Yeah.
that's always a good approach where it's like a compromise, right? Where
Mm.
they're thinking, okay, no, I want to stay with what I know. I'm saying, hey, here's a recommendation that I think will improve your business. The middle point is to say, well, let's do a test. I can run both of these things in parallel. And at the end of it, you'll find out who the winner is, right? So we're big proponents of A/B testing,
Mm.
champion challenger. I mean, I've been doing those types of tests since I first started my career because that's how you really find out, right? You do some
Of course.
experimentation, right? And then yeah, this is the better solution. Now we can go full bore and put it in production and move forward.
Okay.
But you have to be diplomatic, right? I mean,
Of course, of course.
yeah, because at the end of the
Because at the end
day,
of the
we're
day,
we're trying to serve clients, right? We're trying to
we're trying
serve
to
their best
serve their
interests.
best interests.
And, that's
And,
what we bring
that's
to
what
the
we bring to the
table is
table is,
just saying, look,
just saying, look,
this is what
this
we
is
recommend. And it's always done respectfully, right? I've never had a situation where it's gotten into very argumentative or kind of anything angry. That's not the right way to approach
Of
business
course.
in my perspective, but
I mean, it clears to show you're doing it the right way, clearly.
trying to.
trying to.
I guess
Um,
it's a learning process, but I mean, yeah, I can already tell, Matthew, you're very knowledgeable on the subject. So I feel like, when someone just comes with overwhelming knowledge, you don't even need to have any ifs or buts. Like, I'm just gonna go with what you say.
Right, right. And it depends, a lot of it actually depends. And for any fellow consultants out there that might be listening, I think it's also about reading your client, right? And
Mm.
understanding like where are they coming from and just recognizing, look, if they're in a situation where they've been doing, like I said, they've been doing things for 30 years the same way, that's going to be a much more difficult conversation than someone who's very open to, hey, I want to try something new. I want to do something different because I know that I need the help. Those are totally two different kind of approaches in terms of the way you have to think about it. So always be cognizant of the client and who you're working with. And that's what the approach we like to take in any engagement.
Yeah, absolutely. I feel like even we can relate to that as well because, like you said, every client's different. Every client's got different needs. So I guess you can still have that like personal touch to actually make them feel unique, and you're actually not just there for the money, but actually you actually want to see the services improving their business, have better outcomes in terms of you, which is risk. Then by all means, it's mutually beneficial.
Absolutely. Yeah. I mean, that's, a big part, and I didn't touch on this earlier, but why I, stepped back into the entrepreneurial world to found Ogma was to help clients solve problems. I mean, that's at my core that I love being able to do that,
Mm.
and because I'm a problem solver by nature. And so to be able to do that in collaboration with other people is really exciting, right? And that's where I think tools like AI allow for so much more potential because it really opens up avenues of I don't have to spend a bunch of time doing maybe kind of rote or things that are very tedious. I can let someone else take care of that, even if it's an AI agent or, and as long as I build that trust that it's working, that allows me to be more efficient and focus on kind of the relationship and the human part with my client and really open up all kinds of new possibilities.
No, without a doubt. So, in terms of AI in your industry, Matthew, how do you think it's actually going to impact it?
I think there's a couple of different areas really that and I think there's been a lot of discussion around maybe fear that AI is going to replace jobs, right? And I'm sure you all hear this a lot
Yeah.
with your business, right?
Well,
Yeah, and I think so there's a couple of facets. One aspect is, as I kind of just mentioned, I think there's going to be an efficiency play where tools like AI will allow people to do more with less, right? So I can actually maybe not be tied down or burdened with a bunch of stuff that are more task oriented, right? And any good risk management person will tell you there are a lot of task driven components of risk management. And so if I can offload some of that, that might allow me now to get more creative, think bigger picture, utilize these tools to my advantage. As an example, I don't think credit underwriting will be done necessarily by an AI agent at some point. I think what an AI agent can do is help me design a better model, identify data sources maybe I'm not contemplating, or come up with new techniques, right? Or help me automate tasks. I mean, I think that's a huge opportunity. Once you identify those KPIs and you agree on what reports are important, okay, let's start automating these things so I don't have to think about them, right?
Of course.
Yeah, I mean, and that's where I think you can leverage and lean into tools like AI. I think you still need that subject matter expertise, right? So I've seen some models that were developed using AI, right? And I would often ask the folks that have been using them, I said, well, how would you interpret this specific attribute in the model? What does this mean in the context of, assessing this consumer's risk? And they couldn't answer. And I said, well, here's the problem. I said, you can't put that in front of a regulator and say, well, I'm not really sure how to understand what this means in the context of risk management or, assessing risk of the consumer. So you still need that knowledge, right? And you need the people that know what questions to ask or how to frame the problem correctly to AI, to the AI agents, whatever the case may be. So I think there's going to be a lot of growth and kind of utilization of these tools over time. But I don't envision a world where it's just going to replace kind of the credit risk, frameworks or the credit risk, all the talent that's in the credit risk ecosystem. I just don't see that, yet.
Because I think one thing we've definitely noticed is that I feel like a lot of companies are just rushing to be the first with AI, but they're forgetting the human touch element and to actually balance it out. And I feel like that's why when we kind of create the business, we said that our mission statement is handling AI with care as well, because I feel like that is the imperative part, and people actually miss that more often than not.
Absolutely. No, it's really important because, we're all still humans, right? So
Yeah.
we want that human component. And it's funny, one of my good friends, he has a company that actually looks for opportunities with companies that are building AI. And they try to help foster and figure out, okay, what human centered problem are we trying to solve, and how can we make sure that human element is in it. And one of the tools they built, it was for a collections agency. So once a loan charges off, they often goes into a third party debt collection agency. They created a collector, completely AI based collector, but it was empathetic, right? It listened to people's stories. It talked through, well, what are you going through that got you into this situation?
Mm,
For some consumers, they just need that little bit of outlet to help them reframe their own position and to say, okay, I want to take care of this debt, right? But it created this like human touch
mm.
that it wasn't just robotic. It was, let's bring in the human element. And I think that's going to be really important over time, as these tools continue to evolve.
Without a doubt. So I did want to flip my previous question just on its head a little bit. So obviously you've spoken how AI can impact your industry. Are you using it in your business currently, or?
Yeah, I utilize it for research. I utilize it to, oftentimes I'll actually take, because some of what we do are assessments of like a risk environment. So one of our offerings is called the foundation, and we come in and we do a full-on assessment of what that company is doing from a scores perspective, from their strategy, their data, and then we'll identify gaps and we'll come up with like a whole assessment of what kind of their current state is. And what I'll do is I'll often run that through, ChatGPT and Copilot and say, are there any other things that I might be missing? What are some like initial recommendations? And like I always cross check it with my own knowledge, right? So
Of
that's
course.
the other thing. Like, so I've just utilized it to become more efficient. Additionally, my analytic partners, they're actually building out agentic AI right now. So they're building agents focused on doing things like executing marketing campaigns, assisting with risk strategies, creating loan officers that are agents, right? But they, again, they can go and do a bunch of these tasks that as a human, I don't necessarily want to spend time on it. Go collect pay stubs, go get bank statements from the consumer, prompt for email messaging to see if the consumer is interested, right? Again, that's the benefit of I can now have that task-driven work done by an AI agent. So it's kind
It's
of a
kind of a
mix
mix
of
of
research
research
and
and
some of
some of
the
the
kind of analysis we're
analysis we're
doing,
doing,
coupled
coupled
with
with
starting to
starting
get
to
into
get into
agentic
agentic
AI.
AI.
And that business is, for any of you that want to look into it, it's called Stratlytics. They're out of India, so they're starting to build out some pretty cool and sophisticated tools in the space.
Matthew, I
Yeah.
have to say, it sounds like you're way ahead of the curve.
I'm not sure about way ahead, but we're trying to at least stay on the curve, right? I mean, and it's tough. I mean, you all probably see it plenty. It's changing quickly. I think you made a really great point that there's many companies that they want to be that either first to AI usage, or they're really excited and trying to get all this focus and investment in AI, but they don't even know what problems they're trying to solve,
Yeah.
or if they haven't asked those fundamental questions of why do I want this? Like, what improvement can I make? Right. And like we always talk about, sometimes there's a big movement towards using more AI and machine learning, which, by the way, has been around for decades, but it's just gotten much more sophisticated now. You can get results that are really hard to explain. So it might produce the best prediction that you could get, but I can't
But
explain what's
why?
in the, yeah, but why, right? So we caution clients to say, okay, I would rather give up a little bit of predictiveness so I have more explainability, especially if I'm a heavily regulated in a heavily regulated country, right? Like the UK, the US, like those regulators are going to want to understand and know, okay, what does this model mean? If you're, not giving a consumer a loan, what are the reasons? Did you provide adverse action, right? Can you do all these things that you're supposed to do? And sometimes we get into a trap where, well, the technology just said it was good. And so,
Yeah.
and that's not going to be a good enough answer, right? And it doesn't create fairness for the consumer, right? Because as a consumer, I want to know, I want to get that mortgage. What do I have to do differently, right? And if I can't tell the consumer that, I think it's imperative on the financial services industry and ecosystem. And we've come a long way in the last 20 to 30 years in being able to do that, right? We've enabled consumers with tools through like Credit Karma and being able to simulate your credit score and how, if I make this change, what happens. So now consumers are more empowered than ever, and they also have a lot of choice in the market, right? So I think it's imperative for lenders to be able to, not just from a legal and regulatory perspective, but just from a moral perspective, to say, here are the areas to improve on, and we'll consider you in the future. And not to say that, there are a lot of lenders that are doing that today, which is great. And I think it's just, continuing to improve on that.
Without a doubt. But Matthew, I do want to get your opinion on something though. So obviously, AI is a very rapidly evolving industry, and I feel like because at Navvai we have our deep research sessions every week, and one thing we see is that like countries are now coming together to form some type of AI policy, but because it's evolving so fast, that means there's a risk of it always being outdated the
Out
next
of
day as soon as
compliance.
it's
Or
yeah,
yeah,
exactly.
right.
Do you think it's actually possible to have an AI policy at a current period of time before it gets outdated?
I think that there's a necessity to have something, right? Some kind of guardrails, but you also then have to have the ability to adjust quickly, to your point, right? Because if things are changing that quickly, you don't want the policy to be old that you just made yesterday, which is a scary proposition, right? Because it's like, how do you even keep up with that?
Exactly.
And I think within a firm, firms themselves have to determine, right? Like, okay, what is our policy regarding AI? What use cases do we approve? How do we want to approach it, right? I think, and I've seen this already in many companies, they've started to build their own AI policies. But what's also important, if you're going to have the policy, you also have to have governance, and you have to have
Yeah.
like the reporting and the enforcement. So if you see that things are going out of bounds, you better be able to reel that in, right? Because it then has the opportunity to get out of control. Again, actually another area of risk. This is like all risk management, right? Like I want to be able to create my guardrail and then be able to determine if I'm operating outside those guardrails. And if I am, I better do something about it, right?
Of
But
course.
with all that evolutionary kind of change happening, that means you almost have to have some folks dedicated to just AI and those policies and ensuring like, okay, when something new comes up, where does the company, where does the country, where do they stand on this use case or the utilization of AI in this scenario?
Vow down. No, that's a really good
that's a really good
statement.
statement.
But just
Just
to
to
wrap
wrap
up the
up the
podcast,
podcast,
or
or
surely
surely
anyway, I
anyway, I
just
just
have a
have
few, one or two more questions. That's
that's
okay.
okay.
Absolutely.
Brilliant.
Brilliant.
So
So
I
I
wanted to
wanted to
know,
know
what
what
does
is
next
next.
year for you look like? Because I know you obviously you've spoken about the different innovations that's happening. So just gonna like, what's the goals for the next year or 2 years?
Yeah, I think there's a couple areas that we really want to expand. So one is a geographic kind of focus expansion. So we're looking to kind of do more in the UK, in Europe. I think what's really fascinating, I've had the fortune of being able to work actually globally throughout my career. So I've done projects all over the world. And I really have always enjoyed kind of seeing how credit intertwines within a country's or, a region's kind of cultural background, right? And what does credit mean to consumers and how does it affect their lives and potentially the ability to, I mean, the reality is credit is a tool to help a consumer kind of expand their financial wellness and kind of get up the curve no matter where they're at, right? And so I definitely would like to see us do more in the UK and in Europe. And it's an interesting area because I think there's opportunity to bring some of the rapid innovation and approaches to risk and analytics that we've seen in the US to the UK, right? Because the UK has been more traditionally conservative. They're often like, measure twice, cut once, like very measured, right? Very measured. And
Yeah.
for good reason, because, the regulatory environment's a little different. But I think there's opportunity to do more rapid innovation and do things a little bit differently. So I think that will be something like to focus on. I also think there's a lot of great opportunity in areas like Africa where they're like the fintech kind of push in
Community.
Africa. It's amazing, right? And I mean, seeing things like trying to bring, financial health and wellness to people in these rural areas that are kind of on an oasis, right? And it's challenging for them to get access to these things. And fintech's trying to help solve that problem. So we were actually in the bidding process for this really cool project in Kenya. It didn't come to fruition, but again, I think there's a lot of opportunity in Africa. And then Asia, they've been kind of an area where I think it's bringing education and maybe some of these risk management tools over to Asia as well. So that's one kind of area. I think another area of expansion is product offerings, right? So we're working on a couple of different things. The agentic AI is a great example, but also trying to build out some more software focused solutions for things like IFRS 9, which is some of the regulatory requirements in Europe, interest rate risk in the banking book. There's a lot of, I think, opportunity and need for tools that can help solve some of those problems in a much more efficient way. So again, anything we build that might be initially focused on Europe, we'll easily bring it to the US and vice versa. So I think once you start building that global footprint, then your productization can kind of look in different areas and identifying those needs becomes much easier.
Sounds like you're ready to take over the world, Matthew.
I don't know about take over the world, but I mean, again, just going back to where we started, right? It's very passionate about this kind of work and helping clients solve problems. And I think the reality is there's opportunities everywhere to do this kind of work. And, for areas like Africa that they've been a developing kind of area for a long time, they just don't, there's a lot of components they just aren't aware of, right? So it's an opportunity to bring that knowledge. And, I'm a big proponent of sharing knowledge and I think we all do better when everyone kind of can understand more and learn more, and so I like to bring that to as many folks as we can and do good.
Absolutely. And lastly, Matthew, if you had one piece of advice for new founders, whether they're in the risk industry, the AI industry, what's a piece of advice that you would tell them?
I would say a big thing is be patient and
That's
temper
a good one. That's a good one.
expectations, right? So, I think the reality is there's so many great founders out there with great ideas, very smart, right? And I think if they're looking to help solve problems, they'll get the fulfillment out of the work. The reality is, though, you don't know what that timeline looks like, right? I mean, you might put every best foot forward in trying to bring some great idea to market or some new product to market. And for whatever reason, things don't align exactly how you expected them. So instead of it taking 6 months, which would be unreasonable by most expectations, it takes 5 years, right? So, patience is key. And I would say the other piece is understand what you're in it for, right? So if you're in it to make a ton of money, then understand that that's what's driving you. If you're in it to create change and impact people, then understand that about why you're in it. And that changes the ability to be patient and expectations, right? So yeah, those are some things I've learned over the many years and learn to ride the wave.
Yeah, because that wave it can have a lot of turbulence. The
A
waves can
lot of
just go all the way up
turbulence.
here.
Yep. Yep. And yeah, you have to learn to ride the wave, and this is just a life approach that I have, which is no matter what's going on around me, I always want to be content and happy, with where I'm at in life. And so that's just kind of something I try to live by. And I found that translates well in small business life and entrepreneurship, right? Like just live the best life I can, be content no matter what's happening, because in reality, I'm still above the ground right now, right? I'm breathing. So, it's
It's
like
like
that's a
that's a
pretty
pretty
good
good
victory
victory.
for
For
today.
today.
So,
It's that gratitude, Matthew.
absolutely.
Absolutely.
Always
Always
try to
try to
lead
lead
with
with
a
a
mindset of
mindset of
gratitude.
gratitude.
But yeah,
Yeah,
no,
no,
well
well
done,
done,
Matthew.
Matthew.
And
And
I
I
think
think
it's
it's
quick
quick
to
to
kind
kind
of
of
overlook
overlook
the
the
gratitude sense
gratitude
of
sense of
things as
things as
well,
well,
because
because
obviously you
obviously
can
you
be
can be
so
so
bogged
bogged
down
down
in
in
the
the
business,
business,
and
and
just because
because
you
you
don't
don't see
see immediate
immediate
results,
results,
you
you
start
start
to,
to,
I
I
don't know,
don't know,
like
like
get
get
discouraged.
discouraged.
But
But
like you
like you
said, you
said,
have
you have
to
to
ride the
ride the
wave.
wave.
You have to
You have
ride
to
the
ride the
wave.
wave.
And I
I
think
think
what I've
what I've
also
also
seen,
seen
people will,
people will,
if
if
maybe
maybe
the
the
core
core
focus that
focus that
you
you
started
started
on
on
isn't
isn't
working, then
working,
maybe
then
you
maybe you
pivot and
pivot
then you
and then you
pivot
pivot
again. And
again.
then
And then,
so
so
I think
I think
pivoting can be good if there's a market need for it versus doing it out of fear, right? And so to your point, it's like you need to really ride that wave to understand, because you start having self-doubt, you start having, am I thinking about this wrong? Am I trying to answer a problem that doesn't exist? You go down all of those things, right? And
Of
if you
course.
truly believe in what you're doing and like the focus that you're there for, then you see it through, right? And the market will prove you right or wrong. Like ultimately, you might have a great idea that just doesn't get traction because the timing wasn't right and
Mhm.
whatever, or you might come up with this great thing and everyone loves it and you're off and running.
Without a doubt. But Matthew, I just want to thank you so much for jumping on the podcast. I must say it's definitely been an exciting one. I've learned a lot. Can I just say that?
Well, I'm glad. I mean, like I said, I always like, anytime you can impart knowledge or at least have a great conversation. And I really appreciate you both. I appreciate the invite and the opportunity just to speak with your listeners and whoever else might, come upon. I'll be sure to be pushing it out there. But it was a really great and engaging conversation and happy to talk a bit about Ogma risk and analytics and kind of what we've been up to.
But Matthew, before you go, where can our viewers find you? Can we get your LinkedIn website? Let us know.
Yeah, so if you go on LinkedIn, if you search for Ogma, OGMA, Risk and Analytics, or you go to www.ogmara.com, those are two spots you can find us. We have all of our service offerings on our website. We put out a lot of content on LinkedIn. Connect with me directly, Matthew Komos, Komos, and do a little research on Ogma. I think you'll find it's kind of a cool backstory of where the name originated from. But I'm gonna not spoil it. I'm gonna see if folks can do a bit
a
of
bit of
their
their
own
own
legwork.
legwork.
I mean,
He's
he's not
not.
asking you for a lot, guys. He's really not.
No, I mean that's a simple one, but maybe I'll get you over to our website.
It's true. But ladies and gentlemen, this has been another episode of Navvai Shift. Thank you for tuning in.
Thank you.